So credit rating. What is a credit rating? These are objectives. This is a full handout. I will do the main parts because I had been teaching the entire thing, but they don't ask any question. So I will cover the main topics only, but you can go through if you have time, right? What is a credit rating? It is the assessment of credit worthiness of a borrower in general terms or with respect to particular debt or financial obligation. Credit rating is an assessment of a customer or product on the credit worthiness. Nothing else, just an assessment of credit. Will this customer or the product repay, right? Like, okay, we take a credit rating of a customer. He has a good rating. That indicates this, in general terms, this customer will pay, right? Very unforeseen reasons, if he is not paying, that is a different case. But in general terms, this customer will repay. Then some rating, which is at the lower end, they say it is vulnerable. Due to economic reasons, they may not pay, right? So credit rating represents the credit worthiness of a customer or product. Products like debentures, securitization, there also you can get ratings. That also shows whether this product will pay the interest and capital when it is due, right? This rating can be given to anyone. It can be a customer, corporate customer, or business customer. It can be a country. It can be a government. It can be a provincial government. It can be a product like debentures and those. It can be assigned to anyone. A credit rating can be assigned to any entity that seeks borrowing money, because credit rating just tells the financial institution that this customer's credit worthiness. There are two types of credit ratings. Firstly, it is the external rating, then the internal rating. External ratings are rating given by an external rating agency. We will shortly look at what our external rating agencies are, right? Internal ratings are all the banks are required to rate our customers, whether it is business customer or retail customer. Based on the criteria, we need to rate the customer. So that is the internal rating. External rating is a report given by a third party specialized in rating customers and finding out the credit worthiness of a customer. So that report gives you the credit worthiness. Rating methodologies, we have two rating methodologies. Right? So it's like this. Business will go like this, right? Economic cycle will go like this. Point of time means you take the rating on one point, right? This is the economic cycle. You will take a rating at one point, right? Through the cycle rating is you take when the economy is good and you take another one when it is bad. So you cover ups and down both, right? See, when economy is rising, even a marginal customer will be rated high. See, when the economy is very good, we used to give a lot of temporary facilities, TODs, and all those things. So even a marginal customer, we rate high. When economy is bad, even good customers, we tend to rate down because we are afraid. We think that customer may not pay. So it is differently treated. That's why we are looking at through the cycle. Otherwise, it is little biased. So point in time is where it is 1 point you are taking the rating. Through the cycle is up and down both, you have to calculate and take the rating, right? Those are the rating methodologies. What is external rating? That's, as I told, rating assigned by independent company that evaluate the financial and non-financial condition of a company, sovereign or debt instrument with respect to credit worthiness. So a third party is evaluating this customer or the product, financial and non-financial factors, and giving a credit worthiness report. In that, they say very good, like that, they will give the rating. So rating given by an external third party, independent external third party, is a external rating. The rating is an evaluation. When you have rating a company, rated the company's external rating, we have rating from AAA to D, right? So if you have AAA companies, like only bank in Sri Lanka who has a AAA rating is NSP. So we have AA banks. So when you are considering AA, you can compare across AA, commercial, HNB, all in the same line. So without going through all other details, you know that credit worthiness of these two banks are almost equal, right? Investors can compare the company performance with another company operating in the same market or industry, national or international. Because if it is an international rating agency giving the same rating, so company A, B, C, A and C has the same rating, means they are in the same line of credit worthiness. So when you are taking the credit ratings, it is quantitative and qualitative factors, both we are considering. Key things you should know about rating: it is purely a credit worthiness only, nothing else. It does not indicate hold or buy opinion. It does not indicate anything about the liquidity, right? It is not an investment advice. It is just a report giving, it is part of the investment advice. So this says credit rating assesses the creditworthiness of a corporation or even a country. The credit rating tells lender, investor probability of the subject being able to pay back a loan. Creditworthiness is ability to pay back a loan. Credit ratings are not indication of the market liquidity. And again, credit ratings are not the indication of portfolio quality, right? It is an individual company who is capable, what is their capability of repaying. If you give money, what is the probability you will get your money back? When ratings are poor, risk is high. Lower the rate, higher the risk. So then risk-return trade-off comes into play. So when high risk, low rating, high risk, higher the borrowing rate. Because higher the risk, higher the return. We are giving TODs at 24 because it is high risk. Similarly, if a company's rating goes down, their borrowing cost will go up. The poor rating indicates high risk of defaulting on loans and thus leads to high interest rates. When a company's rating starts deteriorating, that means their borrowing cost will increase because it is becoming high risk. So all lenders will add a premium, risk premium. Therefore, their borrowing rates will go up. Some countries, in order to list on the stock exchange, they need the companies to have a risk rating, right? It is depending on the jurisdiction. These are the factors influencing change in risk rating, right? In order to get the rating high, the company should be able to generate stable earning and capital. If a company has stable earning and capital, stable capital, then rating will be higher. Then political environment of a country also required to rate some companies higher, because all these companies and businesses are embedded in the political system of country. If the political system is very volatile, economy will be volatile. So even a good company can't operate properly. So political system, then consistent earnings. You earn this year, if you don't earn the next year, your rating will not be good, right? If suddenly you sell something and show a big profit, rating agency will not consider that because your earning will not be consistent. So higher rating will be there by ability to generate stable earnings and capital, prevailing political stability, and consistent earning. Whereas low factors influencing to bring the rating down, more legislative changes, tax changes, land law changes, legislative changes, significant decline in the company profitability, then governance structure. Suddenly the top management fired, or compliance officers fired, or auditors fired, then rating agencies will look at that. Material alteration to the governance structure could foretell the downgrade, breach of covenants, breach of security covenants, payment delays, failure to comply with any regulatory requirements. That's the country's law, right? Major legislative changes in the country, significant decline in profitability, material alterations to the company's governance structure, auditors, compliance officers, financial controllers, like that. Then breach of covenants, failure to comply to the regulatory requirement of a country. These kind of factors will push the rating down. Rating agency, it is an independent company. They look at rating, they do financial evaluations. Since they are independently evaluating and giving rating, smaller companies or governments, which are, or even people who are not capable of evaluating companies, can rely on risk rating to compare. As I told, commercial and HNB, right? If I want to evaluate, I need financial knowledge to evaluate, right? But if I don't have enough financial knowledge to evaluate the two P&Ls and the balance sheets, I can go with the rating, because rating gives a credit worthiness of this company, right? It is not a buy or sell decision, but it gives you a framework, credit worthiness, right? So same credit worthiness represent same credit rating. So we can consider these two are equal. So whoever is not capable of evaluating can look at this and come into the equity market. So risk-weighted capital goes up. That's the it is this thing. For investors, credit rating agency increase the range of investment alternatives and provide independent, easy to use measurement of relative credit risk. This generally increases the efficiency of the market, lowering the cost. Otherwise, I will have to hire someone who is capable of evaluating. So I have to pay. So my cost will go up. In this turn, increase the total supply of risk capital in the economy, because now anyone can look at the rating and can invest than going through lot of hassles. So our economy will get capital into it, leading to strong growth. It also opens the capital markets to categories of borrowers who might otherwise be shut out altogether. Small government, they rate and they come to the market and say, I'm a this rated place, I need money. You can list. Rating agencies, we have around 75 rating agencies around the world. These are some of the rating agencies. Australia, you have Australian rating. International ratings are Standard & Poor's, Moody's, Investor Services, Europe, Central European Rating Agency, Fitch, IBCA, Japan Nippon Investor Services, Japan Credit Rating Agencies. Like that, we have 75. Right? But all these companies are paid by the customer himself. The company who wants to get rated has to pay them, right? This is the ratings. AAA, extremely strong capital to capacity to meet financial commitments, highest rating. AAA is the highest rating, right? Up to BB minus, it is a investment grade. BBB minus, it is investment grade. That means you can invest for longer tenure, right? Then BBB minus and below, after BBB minus, which is BB plus, up to D, it is D is default, famous default on financial commitments, right? That is speculative, risky, short-term investment only, right? Speculative means risky, short-term investment only. So you just need to have a little idea. Sometimes they ask, what is AAA company? What is AA company? Like that. What is AAA? What is AA, A, B? BBB, you just have an idea about it. From AA to CCC, you can have CCC plus, CCC and CCC minus. So within the same range, you can have a fluctuation, right? Anything indicates only the credit worthiness, nothing else. Just see strong capacity to meet financial commitment, but somewhat susceptible to adverse economic conditions and changes in the circumstance. Means they have capacity to repay, but sometimes economic condition may alter their repayment. right? Consider higher speculative grade, less vulnerable in the near term, but face major ongoing uncertainties to adverse business, financial, economic conditions. That is double B. Double B is speculative. So it is for short term only. If we were thinking about investing 5-6 years, I don't think double B plus is a good place. Then if you are going high, you need to go triple B and above. If it is short term, 1 month, 2 months, 1 year, double B plus and below is okay. Right? That is the rating. This is a comparison. Okay. Yeah. So that is external rating. Do you have any questions on this? External rating. Risk rating is the indication of creditworthiness of a company. It is done by evaluating qualitative and quantitative information, right? It indicates only the creditworthiness, that is, ability to repay a facility. It can be a company, government, or even an instrument, right? Ratings are done on point in time and over the cycle. Those are the two methodologies, as at now and on the economic cycle. Then credit ratings tend to be higher when you have stable economy, stable political system, stable earnings, and regular earnings, right? Stability and regular is two different things. Credit ratings tend to be lower when you have legislative changes, when you breach any covenant, governance structural change, or if you don't meet the regulatory requirements, risk rating tend to come down. When the risk rating comes down, your borrowing cost increases. That is risk-return trade-off methodology, right? So external ratings and internal ratings. External ratings are the ratings which are given by independent third-party companies, specialized in rating others. They evaluate the financial and non-financial factors and give the rating, right? There are 75 rating agencies in the world who are being paid by the company who is being rated, right? So it is not independent basically. Though it is independent, there is an influence because they get paid by the customer himself, right? But it is an independent company. Risk rating is not an investment decision, but it is a supporting document for an investment decision. Risk rating gives only the credit worthiness. It is not any indication of the liquidity. It is not a direction to buy or sell, right? It is not an indication of quality of the portfolio. It is only individual companies' credit worthiness, right? Rating, external rating start from AAA, that's the best, and default is the D. AAA to BB minus, it is investment grade. That means you can invest for longer tenure. Double B plus to D, it is speculative. That means short tenor is good, but long tenor it is subject to economic and all other conditions, right? Rating A. Then this thing, so you need to look at those ratings. Yeah, that's all. Then internal ratings, I will discuss the internal, which are the existing the banks customers you have to rate. That is external. I will discuss now on external internal rating. Right? Any questions? Can I proceed? See, sovereign rating is the government, right? Though we are in the political system, they rate governments separately, they rate companies separately. Political system is only a part of us, right? Always country, when you are considering country rating, it depends on lot of factors. But when you talk about NSP, it will have only some specific factors. You can have differently. Like, see, sometimes, if I can remember correct, even NDB, when we were AA plus, our debenture rating was AA or A plus. Right? Same company, that product is different. Right? So we will be compared to all CCC countries. But within that country, you can have a better rated bank or anything, which will be rated among the banking sector. Malika, did I answer you? Okay. Anyone else? Any other questions, or can I proceed? Right. So, see this. This was the older one, right? Sri Lanka sovereign rating was BB minus at that time, right? NDB A minus, but NDB subordinated debt was A, right? Rating methodologies I'm not going to do. This I discussed. Trade rating are useful method for lenders to assess the credit worthiness. Sovereign rate into account the overall economic condition of the country. That's what I just explained. Right? Institutional investors rely on sovereign rating on qualify the general investment atmosphere of a particular country. So whether general investment atmosphere. Trade rating can be issued to individual companies, debt instruments separately, and indicates opinion on the ability to honor the debt obligation. Regular requirement to have public rating. Models. Limitation of external ratings. Companies have not been downgraded. Like, rating has to be reviewed regularly. But what happened when financial crisis happened? JP Morgan was a AAA bank, but it collapsed, right? So they had to face issues. Northern Rock was a AAA bank. It collapsed. CRA has been criticized for having too familiar relationship with company management. CRA are paid by the company itself. That's what I told you earlier. Credit rating agencies are paid by the customer who needs a rating. So rating agencies become very familiar with the management. So whether they are doing independent, purely independent job is doubtful. They have given wrong opinions as well in the past. Suddenly you downgrade, like Sri Lanka was downgraded by 2 notches, right? Then our all in borrowing cost increases. Lenders increase the premium. So that is very difficult for company over sovereign. Sudden downgrading of a debt instrument by the CRA will lead to high capital cost to the financial institution or to the sovereign. Right? That is the difficulty in rating, change in the rates. Then we go to internal rating. All banks are required to assign internal risk rating across all their credit activity, including consumer portfolio. As per the CBSL and Basal both, you need to rate your portfolios, whether it is SME, corporate, retail, but you need to rate the portfolio. That is to see how is the credit worthiness of each customer. There are 2 types of rating. Firstly, obligor rating, and secondly, it is the facility rating. Obligor rating is the risk of borrower defaulting. It's the individual person. Facility rating, an individual person or the company, individual entity, and it gives the probability of default. What is the probability this entity will go bad? What is the probability this entity will go bad? Whereas facility rating, it can be lease facilities, it can be loan facilities, hire purchase, pawning. Transaction specific factors and determine the loss parameters. That means if this facility goes bad, what will be the loss we incur based on historical performance, loss parameters. So we have 2-tier rating system, obligor rating and facility rating. Obligor rating is on the customer, right? It gives the probability of default. This customer will, what is the probability this customer will default? Then facility rating is the loss parameters. That means transaction oriented, lease facility, ODs. ODs is high risk. Why? Normally when the ODs go bad, we hardly recover anything. But on the other hand, leasing, it is not high risk. 100 million goes bad, we normally collect 80 million. Whereas 100 million goes bad, on an OD, we collect 40 million. Right? Like that. So facility rating take into account transaction specific factors and determine the loss parameters in case of default of the instrument. Right? Use of internal rating system. We use internal rating system to calculate our risk-weighted capital. Capital adequacy ratio, we use risk rating. Then risk rating is used as a risk management tool. Use of internal ratings, firstly to calculate our capital requirement, secondly as a risk management tool when you have rated, you know this slice of the portfolio is AAA. There you don't need to do much monitoring. But B and below, we need to monitor and proactively work with these portfolios. So we can allocate resources based on the risk ratings. That is why it is called risk management tool, right? Then factors to be considered in establishing a risk rating. We are talking about internal rating. Tested customer can be given a good rating than a new customer. Length of time the borrower was known to the institution. Conduct of the past. 5 years he had been with us, but conduct was bad. Then we will rate him low. 5 years he is good, but bad conduct. Then we will rate him bad. Integrity of the people behind the business and management. Integrity and the character is the key. Market reputation is very critical. Based on market reputation, many things can happen. Even customers will stop buying from these companies. Suppliers will not provide raw material, services to a company. Therefore, market reputation is very, very critical. Financial indicators of the company or the entity, P&L and the balance sheet performance, sensitivity to political, technological, and economical changes. Whether this company is heavily dependent on technology, politics, and economic changes, right? So these are the factors to be considered when assigning a rating. Tenure with the bank, conduct, past conduct, integrity of people, market reputation, financial indicators, that is the P&L and balance, sensitivity. Lending does not depend purely on the credit rating. You have to look at collateral, pricing, repayment periods, what are the covenants we can impose, all those things you have to additionally look at it. Risk rating needs to be reviewed regularly. If a customer's risk rating, when you review, if the customer's risk rating come down, you have to watch list the customer. We discuss what is watch listing. It can be in areas or it can be risk based, right? If you think that his markets are down, you can, but still he is paying, but in the future he may not pay us. So you can watch list. Similarly, when the ratings comes down, you watch list. Like now, all the companies who has requested for moratorium, we have watch listed because we have downgraded the companies because they showed a cash flow difficulty. Final authority of a credit rating is the credit committee. Right. That comes to the end of rating discussion. Internal ratings are the portfolios rated by the bank itself, taking into quantitative and qualitative factors, but you need to categorize or rate all your portfolios. It is not only business, even retail portfolios you need to categorize, right? Two types of rating, obligo and facility. Obligo is the customer, facility is the product. Obligo rating gives the probability of default and facility rating gives determine the loss parameters. What will I lose? Use of internal rating, capital calculation and risk management tool. Other factors you can use: length of time, conduct, past conduct, integrity of people, market reputation, financial indicators, P&L and balance sheet, sensitivity to the political, technological, and economical changes. Okay. And additional review has to happen regularly. Downgraded rating, customers you need to watch list, and final authorities, credit committee. That is all for rating discussion. Okay. Yashanti, we also don't know how we were classified as triple C. There are a lot of conspiracy theories on that, right? Because as a country, we have never defaulted, right? Though we have a current account deficit, we have never defaulted any loan or delayed any loan repayment in our history, right? But we don't follow pure IMF guidelines. They wanted different reforms, which we don't do. That's how this has happened. So it is little political as well. Right? Ishanti, did I answer your question? Any other questions? Any other questions? So I can go to the other topic. Can I start the other topic? Right. Now we will discuss about risk. Right. What is risk categories in the Basal? So this one, bungee jumping, and this is tsunami. Right. I have classified this as risk and this as uncertainty. If the difference between uncertainty and risk is, if it is to become risk, you should be able to quantify the damage, right? Uncertainty is, if the event occurs, we don't know what will happen. You can't quantify and say if tsunami comes again, we will lose only 50,000 lives. But here, bungee jumping, you can say if 1,000 people jump, only one person will die due to breaking of the rope. Right? It is based on the history. Like our loan portfolios, we know that when you give loans to SME customers, 10% may go bad because our SME NPL is about 10 now. 10% goes bad, but 90% good. On average, 10%. Like that, we should be able to quantify and say this is the damage it may occur, right? So that is how the risk and uncertainty differ. Then risk structure within a financial institution, we have two main board committees, board risk committee and board audit committee, right? These two, board risk committee and the audit committee, are the watchdogs of the bank, right? These has to be headed by non-executive independent directors. These two committees especially has to be headed by non-executive and independent directors. What is non-executive and what is independent? Non-executive means directors are not paid a salary by the company. Like CEO is a director, he's an executive director because he is paid a salary by the company and he has a vested interest to see company performance are good, right? Independent means they should not be directors because they have lot of shares due to shareholding. When you are a shareholder, you have an interest to see the company is operating properly and you are making profits, right? Independent directors are representing other institutions. They are not holding any major investments, right? In that scenario, they want compliance, they want procedures, they want proper way, not only profits. So these two watchdogs need to be headed by independent and non-executive directors. Under the board risk committee, you have three more subcommittees, which is credit committee, ALCO, asset and liability committee, operation risk committee. Credit committee, as the name suggests, looks after the credit risk of the bank. ALCO, asset and liability committee, looks after the market risk of the bank. Operation risk committee looks after the operation risk of the bank, right? Then when it comes to risk, we have four ways of tackling. Firstly, avoid. That is the easiest. Don't take any risk, just avoid. The second one, accept it and proceed. Third one, try to reduce the risk, right? How do we reduce the risk? One example is taking a mortgage. Put in some conditions. You reduce the risk. Try to maintain and reduce the risk. Then you transfer the risk to someone else. Like in businesses, key man risk is one of the key risks. That means business depends on one person. If he dies, what will happen? It is a risk to the bank. But there are some other parties who is interested of taking that burden. So you take a life insurance. So if something happens to my business person, insurance company will pay. You have transferred the life risk to insurance company. You transfer the fire risk. If something goes wrong, it's fire breakout, fire insurance will pay. So you have transferred the risk of fire, loss due to fire. Like that, risk can be avoided, accepted, reduced and transferred. In the financial institution market, we have something called derivatives, which transfer risk from one party to other. Right? In Sri Lanka, we hardly do derivatives. We are not allowed to do derivatives. Therefore, it's little unfamiliar to. Insurance is one way of transferring. That's why I took insurance. So if I give you a definition, risk is the exposure to present or future loss of profits and or capital. Risk is the exposure to present or future loss of profit and or capital due to faulty analysis of current circumstances or probabilities, due to the mistake and the faulty analysis of current circumstances, or due to future changes of pestly environment. What is pestly? Political, economical, social, technological, legal, and environmental. That is the macroeconomy. Future changes in the macroeconomy. Look at what happened Port City. When the regime changed, Port City stopped. So it is a risk, political risk. Right? Risk is the exposure to present or future loss of profit and or capital due to faulty analysis of current situation or future changes in pestly environment. Risk management is the process of measuring or assessing the actual or potential damage of a particular situation and take necessary actions to minimize the effect. Measure, assess actual or potential danger of a particular situation and take necessary action. This one. Assess the risk, plan the policies and controls, implement, monitor, evaluate. This goes like a circle. This is the risk management. This is PESLI, political, economical, social, technical, legal, and environmental. We discussed this. This is to look at the macroeconomy. In lending, bank face two risks. That is borrower's risk and transaction risk. Right? We told when you are talking about risk rating, you have borrower's risk rating and obligor and instrument risk rating, two risk ratings. Probability of default and the loss parameters. Similarly here, borrower's risk and the transaction risk. Borrower's risk is industry economic risk, like we face borrower's risk due to industry economy. That is due to inflation. Borrower's ability to pay comes down. Forex risk. Forex changes, so his ability of repayment comes down. Industry structure risk. Risk inherited to the industry. Construction industry, tourism industry, fisheries industry, agriculture industry. That industry structural risk. Operating errors are errors and frauds within the borrower. Right? So borrower's risk comes from industry economic risk, industry structural risk, and operating risk of the borrower. That is the borrower's risk part. Then transaction risk, it is inherited in the lending. Wrong terms and conditions, wrong maturities, wrong collateral take. For a term loan, you take a stock mortgage. Then stock mortgage is a fluctuating security. Term loan is an increase in security. So it is wrong. Borrower's risk, transaction risk inherited in lending. Terms and condition, maturity and collateral. This is called financial risk in lending. Right? So risk can be slice and dice. These are major risk categories. There are so many risk categories, but these are the major risk categories in banking or financial risk. Credit risk, market risk, operation risk, then reputation. Reputation is very, very vital. Liquidity, legal and regulatory. There are other risks as well. These are the major risks in financial institutions. So market risk, we will be discussing like these are the three major risks. Those are the major risks, but out of them, these are the major key risks we consider in financial markets, right? Market risk, credit risk, and operational risk. We will go detail into credit risk because our subject is credit risk. Market risk is the risk arising from interest rates, commodity prices, currency risk, equity risk. That is, market risk is the risk arising from changes in interest rates. We see you lend for longer tenor fixed rates, right? Today, rates are around 9%. You lend it for 10 years at 9. Your deposits are at 4%, 5%. After a year or two, your deposit rate jumps to 10%. You have lent at 9%. You have an issue there. Can you remember this? This is how you have been funded, right? We don't have 10-year, 6-year long tenor deposits. CASA, this is very volatile. This is volatile. This is overnight. And again, this is variable, right? So you fix a rate for 9% today, whereas our deposit rates are around 5%. Right? After a year or two, deposit rate jumps to 10%. Now you are losing. You are making profits here, but now you are losing. That is the interest rate. So market risk, interest rate, then FX risk, change in the exchange rate, you get loss. Then commodity, that is like you know what happened to pawning market. Gold prices goes down, banking industry like today you are paying 80,000. Summary goes down to 60. What will happen? You will make a loss. Then you have equity, stock exchange, right? It fluctuates, so the banks will have issues. So market risk is interest rate. Market risk is risk arising from interest rate, forex, commodity, and equity. Then you have market risk, credit risk, and operational risk. Credit risk is twofold. Default risk and concentration risk. I will explain these two, and prior to that I will finish this. I finish this. Operation risk is the risk arising from people, processes, procedures, and systems. Operation risk is the risk arising from people, procedures, processes, and systems. Right? Any risk arising from those things. We have three types. That is process, infrastructure, and model risk. So it is people, procedures, processes, and systems. Right? Is the model. So that is operation risk. Any risk which can't be classified here goes here. Right? This is the default or the transaction risk. That is the concentration risk. So basically, for your understanding only, I spoke about these two, market risk and the operation risk. Credit risk is the subject here. So we will be talking about credit risk a little bit more. Type of risk, then we go to credit risk. Risk due to an uncertainty in a customer or the counterparty's ability to meet its obligation in accordance with agreed upon terms. That means, in very, very layman's term, what is credit risk? It is, will I get my money back? Will I get my money back? That is, when a bank lend money, I have a risk. Will I be able to get my money back? Right? When a depositor comes and gives the bank money, deposit money, he or she will run into the same risk. Will I get my money from the bank? What happened? Golden key. People deposited money. Now they are not in a position to get that money. Swarnamal finance. They deposited money, but now they can't get the money. So that is the credit risk. Will I get my money back? It is the, in more professional term, risk due to an uncertainty in a counterparty, is the other party, ability to meet its obligation in accordance with agreed upon terms. Right? Go to other slide. Credit risk is an investor's risk of loss arising from borrower who does not make payment as promised. Such event is called a default. Other term for credit risk is default risk or counterparty risk. That means I give out money. Will I get my money? Just hold on. You didn't tell me, no? I didn't share my screen. Can you see the screen now? You can't see, Sanjeev? This one? Sanjeev, you can't see? Ishanti?
No, sir, not yet.
Can you see now? Is it clear? Okay, right? So it is credit risk is, basic terms, credit risk is, will I get my money back? That is the counterparty, the borrower's ability to repay as per the agreed terms and terms, right? It can be loss of principal, that's the capital, interest loss, or difficulty in cash flow, decrease in cash flow, or difficulty in collecting by increasing the cost. These are some examples. Mortgage consumer do not make payments due on mortgage loans, credit cards, those things. A business does not make payment due on mortgage, credit cards. Business or consumer does not pay on a trade invoice. All those, even will I get my salary? It's a credit risk. We are giving our services to the bank on credit terms, right? I will perform my job, then only bank will pay at the end of the month. Will I get my money? Type of credit risk is default risk and concentration risk, right? Default risk is when the bank thinks that customer is unlikely to pay us in full, or if the client is more than 90 days in arrears, which is NPL, then we consider that as a credit risk or default risk. If a customer delayed by 1 day, 2 day, 3 day, 4 day, but he comes and pays, then it is liquidity risk. Not in a position to collect money as required, right? Then it is liquidity. But these customers are paying. But if customer goes above 90 days, most probably he will not pay, right? Then it is credit risk. Up to 90 days, if the customer is paying time to time, that is liquidity risk. Above 90 days, it is credit risk or the default risk, right? Then you have concentration risk. The risk associated with single exposure or group of exposure with the potential to produce large enough losses to threaten the bank's cooperation, right? It is the single or group of exposures. If goes bad, create a material impact to the bank's operation, cooperation, that is lending. It is the single or group of exposures. If goes bad, create a material impact for the bank's cooperation. It is not cooperation, it is cooperation, right? Ishanti, still screen is not visible?
No, sir.
All others can see. This one? Still you can't see? Ishanti?
No. Still not visible.
What about now? Can you see now?
No.
Dilanja, you also can't see? Students are paying hand screen. Put a camera. Give me 1 minute, they will come and see, check. Screen share. My entire screen share. Huh? Can you see the board presentation now?
Yes, sir.
Okay, right. Thank you.
Sir, still we can't see.
You can't see?
No.
But we can see, sir.
Some people can see. Huh? You need to pin the presentation. Okay. You need to pin
Now I can see, sir.
Huh?
Now I can see, sir.
You can see. Okay.
No
Okay.
issue. Yeah.
Right. Okay. Right. Thank you. Right. So I will stop the presentation. So concentration risk is twofold. Name concentration and sector concentration. Right? That is, what is concentration? Single or group of exposures if goes bad, will create a material impact to the bank's cooperation, right? So when it is name concentration, we say Haley's group. We have 25% of our portfolio to Haley's group. If Haley's group goes bad, we have an issue. Think about Nigambu branch, which is a 500 million branch. One customer has 100 million. Another customer has 75 million. Another has 50 million, which is 225 million among 3 people. All others are small. What will happen? Any of these guys goes bad, branch will have a material impact. So that is called name concentration, right? Sector concentration means Nigambu branch, again 500 million, 202 hotels, 150 for fisheries. What will happen if any of these sectors go bad? Within this, you have unrelated parties, lot of unrelated parties. Right? This is a sector. So it is sector concentration. This name concentration also related or unrelated. Right? If it is Haley's group, it is related. But in this scenario, it is unrelated. This is called concentration risk. Credit risk divided into default or transaction risk and concentration risk. Right? That is credit risk. Okay, now you can see the presentation. Then the sound practices for managing credit risk. These are the 4 sound practices. Establish an appropriate credit risk environment. I will explain what it is. Operate under sound credit granting process. You need to have a credit environment. Then you need to have a proper credit granting system. Then you have maintain an appropriate credit administration, measurement and monitoring process, and ensure adequate control over credit risk. These are the 4 steps in sound practice for managing credit risk. First one, establish an appropriate credit risk environment. That is credit policy. We discussed what is credit policy is. That is the high-level guidelines the board is giving to us on lending, credit policy. So director board will give us the direction. Top management has to implement that credit risk strategy. That is the establish an appropriate credit risk environment. Then goes to the operating under sound credit granting. When you are evaluating a customer, you have to have a thorough evaluation process. Borrower, purpose, structure, source of repayment, all those things you have studied 5 C's of credit, you have studied different models, you have studied 9 principles of lending. So all these things should be applicable here. Then you need to establish credit limits. For these customers, we give only up to this much. Like that, different credit limits. Then we need to have a proper approving process. That means you should have a proper delegation. Based on the experience and exposure, you give delegations. for new and extension. And extension of credit must be on arm's length basis. That means there should not be any vested interest of the approver on lending. There should not be any vested interest from the approver on lending. That means I should not give a loan to my own family member, right? I should declare that and get someone else to approve the facility. There should not be undue relationship between the borrower and the lender. Then we go to maintain a credit administration, measurement and monitoring process. Have an in place system for ongoing administration of risk-bearing portfolio. I told you that portfolio needs to be risk-rated. AAA segment of the portfolio is low risk. But how you treat that portfolio is different from how you treat a single A portfolio. Single A, every month or every other month you need to visit and have a report. But for the AAA, annually you make a visit, that's good enough. Develop internal risk rating system. Have an information system and analytical technique that enable management to measure credit risk of on-balance sheet and off-balance sheet activities. What are on-balance sheet and what are off-balance sheet? We have studied it. On-balance sheet are the facilities when granted cash flow out of the bank. Off-balance sheet means contingent facilities. Bank takes only a responsibility. Bank guarantees. On-balance sheet, term loans, credit card, PODs, TODs, all those things. And have an information. We need to have proper MIS. Then we should be able to calculate, right? If I don't have a MIS, I want to know what is our exposure to Ukraine. If when there is a problem in Ukraine, we just wanted to know what is our exposure. Who are the clients who is exporting to Ukraine? If you can't find it, then by the time you find what is your exposure, that country is down. Right? Like that. System for monitoring overall composition and quality of the portfolio. That means portfolio quality monitoring. Then consider future changes in economic condition when assessing individual credit. At the moment, our banks, we have classified industries based on low risk, medium and high risk, based on the current pandemic economic situation. So now we have to revisit those segments. That is, proactively, we consider these segments are riskier. These segments are okay. That kind of proactive situation. Ensure adequate control over credit risk. System of independent ongoing credit review. Can you remember when I draw the credit policy diagram? I showed you CRD, credit review, which is prior to the approval, and LRM, that is after the approval. And I told CRD is credit review, which try to put the credit into perspective, whereas LRM is a direct mail to the head of the approver, where they find errors with you. That is that system of independent ongoing credit review. Credit granting functions is properly handled and credit exposures are within limit. We need to establish exposure limits. If I can approve 100 million, that's it. I can't approve 101. Group, I can approve 200 million. I can't approve more than that. So need to have. Then overall bank, we will have, okay, This is the maximum we will take. 33%, 25%, like that we have exposure limits. Then system for managing problem credit, that is rehabilitation and recoveries. So it is establish an appropriate credit risk environment, that is the credit policy. Operating under sound credit granting, evaluation and approval. Maintain an appropriate administration. Portfolio management, that is risk rating, MIS, portfolio quality, those things. Ensure adequate control, that is the last one, where you have CRD, LRM, recoveries, all those things, right? System for managing problem credit, ongoing reviews, credit function properly, and that's the other exposure limits. Then mitigating credit risk. How to mitigate the credit risk? It is based on risk, like what are the techniques we use to mitigate credit risk? You use risk-based pricing. Higher the risk, higher the return. For high-risk products, you charge more. Like for credit cards, you charge 24%. But housing loans, you charge 9%. For TODs, you charge 24%. But PODs, you charge 11%. Why? You have evaluated and you've taken security and given the facility, POD. But here, TODs, within a minute or two, you take the decision and give. Then it is high risk, clean basis. Governance, that means we try to maintain and control the risk level throughout the tenure of the facility. We have two types of governance conditions, that is positive or negative, affirmative or restrictive. The same thing, positive means affirmative, negative means restrictive. Under affirmative, what we do, we ask the customer to maintain some conditions, like providing insurance, providing financial statements, maintaining current ratios, like that. Restrictive means you will restrict the operation of the customer, dividend payout, then investment in the business, like that you restrict. That is to maintain the risk profile of the customer. Governance, periodic reports, and those things, refrain that those two are two different governance. These two comes from under governance. Then we should be able to ask the customer to repay. Customer should be in a position to repay if we ask. Breach of conditions, you say you repay. Then tightening credit. Earlier we used to give 1 million, now you reduce it. If you see a danger, you reduce to 500,000. Like that, tightening the credit. So these are the methods of tackling the risk. Risk-based pricing, covenant maintenance, early liquidation, or tightening of credit. You limit the credit. Earlier we used to give 5 million, 10 million TODs. Now I'm giving only 2 million, 3 million, like that. Diversification comes in differently. That is, few limited number of facilities, that is the concentration. Few limited number of customers, or you have larger number of customers. That is diversification. It can be customers, it can be products. If my branch has mainly leasing, if something goes wrong with leasing market, you are crashed. So you can have leasing, you can have housing, you can have term loans, like that. You should have a combination of these things. This is the sample of governance. Governance sample, which I discussed earlier as well. Then checklist, that is the stringent credit standard for borrowers and the counterparties, that is revaluation, strict portfolio risk management, AAA this much, B this much, we are not going to increase the portfolio exposure more than that. Then constant focus on changes in economic conditions, segmentation, right? That covers the risk part. Can I answer any questions if you have? Any questions on risk? No questions? Can I proceed then? What's happening? All of you are sleeping on. Are you there? Right. I got one answer. What about others? Right. You have all the details about other risk as well here. You can go through if you want. We talk about capital, right? So I will start Basel, but I'm not going to do Basel thing today. But I will take you through what is capital, right? We have few institutions, which is Basel is a city in Switzerland. BIS, Bank for International Settlements, headquarters in Basel. That's how this Basel name came. So Bank for International Settlements serve as the central bank for central banks. All the central banks are reporting there, but they are not. They can't like impose conditions, but they can give regulations. But they can't come and say to our central bank, you do it this way. Only thing, they will give you regulations. If you don't follow, you will be left out of the bunch, right? So it is foster International Monetary and Financial Cooperation. Then you have IB-Fed, International Banking Federation, which is the main forum to address legislative and regulatory work of the banking industry. IB-Fed. Then you have Bcbs, Basel Committee on Banking Supervision. All banking supervision related matters are discussed and agreed in this committee. The Basel Committee on Banking Supervision member countries are represented by central banks or authorities with formal responsibility for banking supervision. This is the committee which will give out the regulation for banking supervision, enhance the understanding of the supervisory issues, and improve the quality of banking supervision. That is how this Bcbs came. This is the committee where all the central bank or the regulatory bodies sits. They decide on the banking supervision direction, right? We have BIS, Bank for International Settlement, which is the central bank for central bank. Then we have IB-Fed, which is the Federation of International Banking Federation, which is the platform we discuss banking industry. Then Bcbs, that is the committee chaired by all the banking supervision related parties, and banking supervision directions are coming from Bcbs. Why this Basel standard? 1974, there was a bank called Herzog Bank in Germany. They were doing a big transaction in New York, and this was a very small bank. If this transaction failed, this bank would have been wiped out. So what happened? German government got to know about this and they closed the bank. Right? Then all the G10 country governors got together to decide a way to control the international players, the people who are fighting in international market for international deals. Right? They wanted to find a way to control these people. So what they happened, they came out with the thinking, if you are small, do small businesses. If you have to be large in order to do larger businesses. Right? So then they came out with capital requirement. Right? Why capital? That is the only, you can remember the circle which I do today as well. You have CASA, you have TMD, you have term loans, you have money market, you have capital. Right? So TMD means term deposits given by the customers. CASA means current and savings account given by the customers. Term loans are funding obtained from other institutions. Money market is the overall overnight market. So all we are liable to pay without a question. But capital, which is the owner's fund, if something goes wrong, we can go to our owners and say, this went wrong, therefore I am not in a position to pay you dividends this time. Or I am not in a position to return your money, because it is our own funds. It is our owner's funds. That is the high risk category for shareholders. Right? So what this Bcbs said is, you need to be doing smaller businesses if you are small. That means you have smaller capital. If you have higher capital, you can do higher businesses. Right? Losses are three types: expected loss, unexpected loss, and exceptional loss. I'll start with exceptional loss. A tsunami. It is a exceptional thing. Due to some unforeseen reason, you make a loss. It is once in a blue moon, it kind of things happen. Tsunami comes, I don't know how long. Like after Vihara Mahadevi's incident, we had tsunami in 2004. We don't know when it will come again. Right? Similarly, due to some incident, everything goes bad, but we don't know when will it happen again. So we don't look at it. Exceptional losses, we don't look at it. Then we have expected losses. Right? Annually, we project our revenue for the next year. Similarly, we project our NPL for the next year. When you project NPL, you project your provisioning. How much of profit we are allocating for bad loans. So expected loss is tackled through provisioning. So it is again not a loss, risk, because we have projected revenue, we have projected NPL. In order to cover that NPL, we have projected provisioning. So we are expecting that provisioning part, we pass it to the customers by adjusting the interest rates, right? So it is expected loss. Again, it is not risk. The risk is unexpected loss is the risk, because we expect something, but it goes above that, which is unexpected, right? Then we don't have any way to fall back. We can't go to our savings holders or deposit holders and say, I made a mistake and I had this, so I'm not in a position to pay. But I can run to my owners, shareholders, and say, sorry, I am not in a position to pay you. So unexpected loss is the risk. In order to tackle unexpected loss, you need capital, right? You have three types of losses. Exceptional loss, which is exceptional, you don't bother about it. You have expected, you have calculated it, taken provisioning, you have shifted it to the interest rate. So you have tackled it. So it is expected loss is tackled through provisioning. Then unexpected loss, which is the loss above or and above the unexpected loss, which you can't go to your liability holders, you can go to your own shareholders. You go and say you are making a loss. Sorry, you can't help it. So for that absorption of that unexpected loss, we need capital. Role of the capital. This is the role of the capital. Absorb large unexpected losses. Because of unexpected losses, we can't penalize the depositors. In order to protect the depositors, you need capital. Provide enough confidence to external investors, rating agencies. We need any business, we need the owners to fund. Similarly, for banks, external investors will see how much capital you have. What is your contribution to the business? Otherwise, in 5 C's of credit, it is capital, right? Similarly, bank also need owners' capital. These are the three roles of capital: absorb large unexpected loss, protect depositors against other claim holders against the unexpected loss, then provide confidence to the investor. We have invested our money, so we are committed, right? Then capital adequacy, all these things are there. Provide buffer against bank losses, protect creditors in the event of bank fail. That is the all three of that. Then create disincentive for the excessive risk taking, right? That means capital adequacy means you need to have your own capital in order to lend money. I will come to that point, right? Type of capital, we have economic capital, that is the capital required to run the business. Regulatory capital, that is the capital central bank wants you to have. Then bank capital, that is the actual physical capital, right? That's the capital. So now it's like this, right? You have Huh? TMD, term loans, money market, and the capital. Right? What does this mean? Minimum capital adequacy ratio, minimum capital adequacy ratio, or we call it Cook ratio. This ratio was named after the Peter Cook, who was the first chairman of the Bcbs who invented this ratio, and he was the governor of the Bank of India. Right? Capital divided by risk-weighted asset should be greater than or equal to, we say, 10%. What does this mean? In very layman terms, it says, if you want to lend 100 rupees, you need to have 10 rupees of your own funds, balance 90 rupees you can find from any of these methods and lend. Capital adequacy, minimum capital adequacy ratio or Cook ratio is equal to capital divided by risk-weighted asset. Forget about this risk-weighted, right? Now, what says capital requirement divided by 100 rupees equal to 10%. So, capital equals to 100 into 10%, which is 10 rupees. Right? That means you need to have your own capital of 10 rupees and the balance 90 rupees you can borrow and lend is 100 rupees. This is the meaning of capital adequacy. Right? Here, it says create disincentive for excessive risk taking. Right? That means if you don't have enough capital, you can't lend. You can't go and put money to the market if you don't have your own money. For each rupee you lend, you need to have some part of it from your money, and the balance part only you can borrow and lend. Else you can't lend. That is the how Basel started controlling us. If you don't have your owner's funds, don't try to borrow and relend. If you have enough of your own funds, you can do bigger businesses. In order to grow our asset book, in order to grow our loan book, we need our capital. Capital is investors, owners' funds. That is how Basel controls us. Capital, we have three types of capital: tier 1 capital, tier 2 capital, and tier 3 capital. That is these are the tier capital. Core capital or tier 1 capital, which takes paid up capital, that is the common shares, non-cumulative preference share, disclosure, that is the general legal reserve, profitability reserve. Then supplementary capital is general loan loss provision, undisclosed reserve, subordinated debt. That means you can have 5-year subordinated debt in this. You can take a loan. If I have money only, I am paying condition. That is called subordinated, right? It has to be minimum of 5 years. So core capital is the share capital, non-cumulative preference shares, and general provision. General legal reserve, that is revenue reserve. Then supplementary capital, low tier 2 capital, it is loan loss provision, general loan loss provision, any undisclosed provisioning, debentures, 3-year, 5-year subordinated debt, hybrid instruments goes and debentures, right? Then tier 3 capital is subordinated short-term 2-year maturity facilities. It is only to cover the market risk. Yes, I think it's market risk, right? So when you are talking about capital, we have deduction. You need to deduct the goodwill. Then you have to deduct investment in unconsolidated banking and finance subsidiary companies and investment in the capital of other banks and financial institutions. Capital is tier 1 capital plus tier 2 capital, tier 3 capital minus investment in unconsolidated banking and finance subsidiaries and investment in other banks, right? And minus goodwill. Those, then you get your available capital. Tier 1, tier 2, tier 3. Tier 1 is called core capital, right? So I come to the end of capital as well. Now I am left with Basel 1, 2, and 3. So next week I'll do the Basel part. Do you have any questions? If you have any questions, I can answer you now. Sanjay, value of securities to be under haircut rule and provisioning percentage per CBS guidelines provision. Interest rates differ, but time frames are similar. As per the specially mentioned substandard, doubtful, and loss category. What do you mean by that? Yeah, there we had first time the provisioning requirement was right regular plus specially mentioned category into 0.5%, that is the general provisioning, right? After general provisioning, you have substandard, doubtful, and loss. Outstanding minus FSV, outstanding minus FSV into F1, close bracket into F2. F1 I told 1, then someone asked me whether it is 1 or 0.75%. I checked with our people, so they were also not very sure, but one told me, yes, it is 75%. Right? I have to double check with the person who is really doing this. I will come back to you. So if it is 0.75, you take the 0.75% of your FSV. For substandard, you have 20%. Then you have for doubtful, F2 is 50%, and For loss category, it is 100%. Okay. And after the loss category, depending on the time you are in loss category, haircut rule starts. First year it is 0.75, even loss category. After second year, first year only loss category occurs. Right? Loss category, then it goes to 60, 40, like that, it goes down. After 5 years in loss category, you have the discretion to use whatever the discount rate you want. Did I answer you, Sanjeev? Okay. Right? Any other question? If no questions, I'll stop here for today. Thank you.